Hello everybody, I hope all of you are doing really well. My name is Siddhant Mehta and welcome you all to Toofan batch. Today I have two good news for you. The very first one is currently we have been enrolled with 60 plus students for last minute notes of set D paper number 3, and Mr. Divang from Ajmer was able to secure 94 marks in his paper with the help of these last minute notes. And he said, sir, there was not a single question which was outside from these notes. So though we have compiled 300 pages in just 64 pages, but my friend, there is no quality compromise has been done in this compilation. And with this, we have also shared one PDF yesterday with all the enrolled students. This PDF contains of a repetitive question ICAI is asking for this subject. We have prepared this list based on 12 students' feedback, and I've understood that these 27 topics are repetitively asked by ICAI. So we have shared this list with you guys. If you are my hard copy student or you are my soft copy student, check your registered email ID. Also, if anyone is interested to buy these last minute notes, you will have two options. The first one is soft copy view only. Here you will be provided with the access on OneDrive, but for 30 days. This PDF will only be in view only mode. You will not be able to download it, nor you will be able to share it. You can get access to your Gmail account also, and the price for it is just 149 rupees. And if you want to buy hard copy, then you can get either it in black and white color, or you can opt for colorful notes. It will be delivered to you within 3 to 5 days, and the price for it will start from 199 plus delivery charges. So make sure you're able to ace your set D with the help of our last minute notes. Also, the second good news is we have been currently enrolled with 250 plus students for set C valuation. Here we have prepared last minute notes for set C valuation, which are of just 36 pages. And my friend, out of these 36 pages, 20 pages of content is something new to read. 16 pages of content is similar with your CA final curriculum. That's why a lot of students are able to ace this subject within a few hours. If you want to enroll for this last minute notes for set C valuation, then you can check out our Telegram channel. But with these last minute notes, you will also get revision lectures, question bank, and a formula book. All of these content is free for now, so make sure you take benefit of these resources for set C and as set D as well. Also recommend your friends about these notes. Now let's start our revision. Today we are going to revise chapter number 7, that is legal considerations for startup. Here we will understand how to select a right entity type for startup, then how to divide equity among co-founders. Then we will understand about ESOP planning, co-founder agreement, and about intellectual property rights. Let's first understand how to choose an ideal entity type for startup. Now, choosing an ideal entity type is very important because it will lay down the foundation for your entire business structure and operation. Each and every entity type has their advantages and have some disadvantages. Let's understand it one by one. First one is sole proprietorship. Here, the single individual will be the owner of the company. He will handle all the operation. Here, the minimal registration is there, but the person will have an unlimited personal liability, which is a disadvantage. So here the advantage is simple and low cost, but disadvantage is unlimited personal liability. Second entity form is partnership. Here two or more individuals will share profit and losses with them. Here also the advantage is easy formation, but the disadvantage is these partners will have unlimited liability. Then there is LLP, limited liability partnership. This combines features of partnership and corporate, because here you will have partners, but these partners will have limited liability. Also here you will get flexible tax benefits. Then the fourth one is private limited company. This is mostly preferred for startups because it is easier to attract investors. Here this company will be treated as a separate legal entity and the shareholders will have limited liability. The condition is minimum 2 shareholders should be there and maximum 200 shareholders can be there. Then there is one person company. Here there will be a single entrepreneur who will be a shareholder and also a director of a company, and here the advantage is that a single shareholder will have a limited liability. Then there is a public limited company which is suitable for large businesses who are aiming for IPO. Here you can form a public limited company if you want to raise money from public, but for a public limited company there is a stricter compliance because here the public money is involved. Then there is small business enterprises, which is MSME. Now here what ICAI has did, they have mentioned MSME in entity type. Now MSME is not an entity type, MSME is a classification of an entity. So any of these entities can be classified as an MSME if they have turnover as per their specified criteria or have investment in plant and machinery as per their specified criteria. If they are following both these conditions, then they will be classified in MSME. So MSME is not an entity type, MSME is a classification of an entity. That's why we have mentioned MSME registration is available across entity type, and here the classification will be based on investment, and it is eligible for government benefit, because if your entity is classified as a MSME, then a lot of benefits are available for your entity. Then there is a C corporation, S corporation, and benefit corporation. All such corporations are usually formed in US. If you are a C corporation company, then your corporate will be treated as a separate entity. Then the shareholders will have a limited liability, but here there is a double taxation. That means a company will earn profit, and when these profits are distributed to the shareholders as dividend, then they also have to pay taxes on these dividends. That's why it is called as subject to double taxation, corporate profits and dividend. It is suitable for venture-backed startups in US. Then there is S corporation, which is also formed in US. Here there is a pass-through taxation. That means company will not pay the taxes, the shareholders will be paying taxes to the government. That's why it is called as pass-through taxation to the shareholders, and here the ownership restriction apply, because here only 100 shareholders can be the owner of the company, but such condition is not there in C corporation. Then there is a benefit corporation. This corporation is formed where the motive is to create an impact in society and environment issues, and to solve environment issues. So like other companies whose motive is to make profit for the shareholders, here the company's motive is to solve environmental problems, to solve societal issues. So here for a profit entity which is focusing on social or environmental impact along with profit, here they also have to submit an annual report regarding what all impacts they have done throughout this year in a society or in environmental cases. After understanding advantages and disadvantages of a different entity type, now let's understand how to select the right entity type. Now this decision is definitely taken by the entrepreneur, but he takes decision based on these factors. Let's understand this one by one. First is formation formalities. If he is an entrepreneur who wants less paperwork to be involved at the time of formation, then sole proprietorship and partnership is more suitable for him, because in LLC and company there is some paperwork involved at the time of formation of your LLP or company. Then in terms of liability, definitely LLC and company is more suitable here, because here the shareholders have limited liability compared to sole proprietorship and partnership where they have unlimited liability. Third thing is expansion aspiration. If you are the one who want to scale their business, if you are the one who want to expand his business, then LLC and company are more suitable for you, because here it is easy to add investor and to issue stock for the employees and operate across location, whereas proprietorship and partnership doesn't give this benefits. Then in terms of taxation, LLC and companies offer better tax planning, because here there are also some schemes, some directions which are specifically given to the companies. The same thing is not available for proprietorship. Then in terms of social media and e-commerce readiness, so if you are building your business online or you want to have a good social media presence, then definitely you can form LLC and company, because here you have to compulsory register your company with government. So if anyone who wants to search about your company, there are some websites where he can type the name of your company and can get data of your company. With this data, he can understand about your company and also understand for how many years you are doing the business. So this data ultimately helps to build trust and credibility about your company. The same thing is not available for proprietorship. I can't search a proprietorship name through some website and get data of that proprietorship. So LLC and company have formalized structures which help build trust and credibility with customers and are more adaptable to e-commerce platform and online scaling. And the last one is closure and exit. LLC and company have formal exit mechanisms. Definitely this is a good and advantageous point. And sole proprietorship and partnership face challenges at the time of closure. So definitely this is not a beneficial option for entrepreneur. Now, entrepreneur will decide based upon these factors that which entity type he has to opt for. Now let's understand the registration process for startup as LLP and private limited. Don't skip this, because they can ask question on the name of the portal where you have to register or this form name. So understand this. Let's first understand the registration process for LLP. First, you have to create an account on MCA portal. Then you have to obtain DAC for designated partners, obtain DIN for the partners. Then reserve your LLP name using RUN LLP service, which is reserve unique name for LLP. And then file a form LLP1. Fill a form LLP1 with required documents for LLP formation. Pay the registration fees online and receive LLP incorporation certificate. Then obtain DAC for proposed directors. This is for private limited company. Apply for DIN for directors. Reserve company name using RUN services, which is reserve unique name service on MCA portal. Fill a form SPICE with MOA, AOA and other required documents. Pay the registration fees and receive certificate of incorporation. This is a simple process for LLP and company. Now let's understand some registration startup has to do in India. Definitely they have to do this registration once they pass the threshold limit. First is GST registration. This will help you to avail input tax credit and also to avail tax refunds. Then MSME registration. If you want to take the access of some loan or some subsidies or tax rebates which are given by the government, then you can definitely apply for MSME registration. Then there is trademark registration, which will help you to secure your brand identity and protect against unauthorized use. Then PAN and TAN registration is there, which is essential for tax filing or for financial transaction and regulatory compliance. Then there is FSCM registration, which has to be complied by few companies who are into food sector. This will ensure legal approval for food business and build consumer trust. Then there is professional tax registration, which is mandatory state-wise compliance for deducting and remitting employee taxes. Then ESI and EPF registration provide employee social security benefits like health, maternity and retirement cover. And then there is a startup registration, which is DPIIT registration. This will give you some exemption, some compliance benefit and access to scheme of government. Now let's understand our second concept, that is startup equity split among co-founders and equity vesting. So whenever someone has an idea to run a business, then if there is a single individual who has an idea to run a business, then that person is called as a founder. But when there are a group of individuals who have an idea to run a business, then all such individuals are called as co-founders. In first case, there is no problem because he will be the entire owner of the equity, entire owner of the company. But in second case, when there are a group of individuals, when there are two or more people, then here they have to split equity, and this equity should be split fairly with all the co-founders by which they are motivated. Startup equity split refers to the allocation of ownership or equity in a new venture among its founder team members. This allocation is very much crucial, very much important, as it determines co-founders' stake in a company and governs the right, responsibilities and rewards as the business grows. To execute a fair and effective equity split, founders should follow a structured process. The first one is assess contribution. Understand how much contribution is made by the founders. Understand how much time they are giving to the business to grow the business. Are their skills important for this business to grow? Then how much capital they have provided, how they are helping in the product development journey. Understand their contribution. Second, value proposition. What is the unique quality which has been brought by this founder to the business? Whether is his expertise which is helping me to grow, or his network is something which is helping me to grow. Identify and assign weights to the unique strengths or advantage each founder brings, whether it is expertise or network which help in venture success. Third thing is negotiation and discussion. Have a proper and open discussion with the founder members that we should have this proper method for equity split, and these founders should have this much amount of equity because there is this much amount of contribution has been done by them, and why this founder should have a more equity. Such open discussion should be there to avoid some future problems. Fourth one is utilize equity splitting tool. There is one tool called slicing pie method. Now in this method, every founder will decide, each and every founder will come to the consensus and will decide, okay, these are the 10 factors on which we have to make a decision. Now this founder is complying with the 7 factors, so 7 slice will be given to these founder. The second founder is only complying with the 3 factors, so 3 slice will be given to him. The third founder is complying with the 5 factors, so 5 slice will be given to him. So in total it is 15, and then they will split the equity based on 7 upon 15, 3 upon 15 and 5 upon 15. So this is nothing but slicing pie method. Apply dynamic models like slicing pie method to adjust equity fairly based on evolving contribution. And then the last one is formalized agreement. Once you decide how much equity should be divided between the founders, have a proper legal agreement for such equity split. Draft legal agreements clearly mentioning the ownership owned by the founders, the vesting schedule if any, and dispute resolution terms. If they have any dispute, how they are going to resolve this dispute. Now let's understand the importance of startup equity split. Why startup equity split is very much important? Because first is act as an incentive. Because if there is some founder who is putting more efforts than their peers, than their other founders, then definitely he should have more equity in a company. Because if he doesn't have more equity in a company, then he will feel demotivated. But if he got more equity, then it will work him as an incentive. Fair equity split gives them a sense of ownership and responsibility. Secondly, this work as an retention. It motivates co-founders to stay committed and give their best efforts to the company. Third thing is talent attraction. Now, the co-founders can be of 2 types. Co-founder can be the one person who has an idea to start this business, or we can also hire a co-founder For example, Mr. Ankur Wariko, who is a famous YouTuber, he was earlier a co-founder of Groupon India company. Now, this Groupon India was not started by him, but he was hired in Groupon India as a co-founder to establish their good market in India and to run the market in India. So here you can also hire co-founder, and if you want to hire a co-founder, make sure that you are giving him a fair equity by which he is motivated to work in your company. It attracts top talent by enabling equity-based compensation. It is especially useful for startup with limited cash. Also, when you are a startup, you are limited with your cash. Give some equity to the key members who are helping you to grow your business. And fourth, investor confidence. Investor wants to see that ownership is split clearly and fairly. आपने शार्क टैंक में देखा होगा कि जानबूझ के शार्क्स पूछते हैं कि आप सीईओ कंपनी के तो आप कितना ओन करते हो, अच्छा आपने प्रोडक्ट डेवलपमेंट में हेल्प किया है, आप कितना ओन करते हो, देखने के लिए कि वेदर दे हैव अ क्लैरिटी इन द स्प्लिट, इन द इक्विटी स्प्लिट अमॉन्ग द मेंबर्स इन द कंपनी. Because once a company starts to run smoothly in ahead, and once they start to have a profit, then there are fights between the founders that they should have more equity than their founder members and their other founder members. So to avoid such situation, investor always check that whether the equity has been split fairly between these guys. Investor wants to see that ownership is split clearly and fairly. It shows the team work well together and lowers the risk of future problem between the founders. Now let's understand some things to consider while deciding equity split. The very first thing is future dilution. Founders has to understand that in future they have to raise some funds from investor. At that time they have to issue some shares to such investor. Also they have to issue some shares to employees under ESOP plan. So when they will issue such shares to these people, their ownership stake in a company will reduce. To avoid such a situation which will happen in future, what you have to do is you have to keep some shares aside in the company and the name of reserved shares. And whenever such activity has been done in a company, issue the shares from reserved shares to the investor and to the employees. Let's understand this with the help of an example. Here we will take the example which we have taken in previous lecture. Amit and Neha used to own the company, having 50-50% stake with them. But when they have a fundraising activity, they have given 20% stake to the investor, and now you can see their own stake has been diluted, and currently they owe 40% in the company. To avoid such situation, what they have to do is, when they will start the business, give 40% to Amit and give 40% to Neha, and have 20% shares as a reserved shares in a company. Reserved shares means shares which are there with the company, but these shares are not issued. So whenever there is any fundraising activity or you have to give some shares to the employees, allocate them the shares from this 20%, by which this 40% which is owned by Amit and Neha doesn't get affected from it. This is the first condition. This is the first thing which you have to consider. The second is vesting. Have a vesting schedule formed in such a way by which the founder is retained in your company. For example, there is a common rule for vesting is a 1-year cliff, and then the full vesting is done over the 4 years. That means when you will join a company, for 1 year you will not get any shares, but after 4 years you will get the shares over the period of time, either on a yearly basis or monthly basis. So here vesting schedule means founders earning the shares of the company but over the period of time and not in 1 year. This condition is imposed on the founders so that he is committed towards the company and he is retained in company. Then the third is exit scenarios. Think ahead about what happens in case if a founder leaves. If a founder leaves, then how his shares will be reallocated between the founders who are now currently running the business. Have a proper method for that and include that method in your legal agreement. Set clear rules to handle equity in such situation to avoid future conflicts. And the fourth thing is legal and tax implication. Understand what all compliance you have to do when you split the equity between the founders and make sure you are complying with each and every regulatory requirement. This will help you prevent future legal or financial trouble. This was all about equity split. Now let's understand about equity vesting. We already know equity vesting means shares which are not given to the founders or to the employees in a year. They are given it to them over the period of time. So this period of time to which in which the shares are given to the employees or the founders is called as a vesting period. The purpose of equity vesting is to encourage long-term commitment from founders and employees by rewarding ongoing contribution to the company. Here, if someone, founder or employee, wants to leave the company in between, then they will only get the shares which are vested. They have to lose the shares which are unvested. That's why this equity vesting promotes loyalty. and ensures that equity goes to those who stayed over the period of time with the company. This was all about equity vesting. Now let's understand our third concept, that is ESOP planning. ESOP means equity stock option plan. So here, having an ESOP in a company gives threefold benefit to the company. The very first one is attraction. You can attract top talents in your company by giving equity shares, by making them feel that you are also the owner of the company. Now this also motivates them, because if they work, company will grow, and if company will grow, they will have a wealth from it. And the third thing is, these shares are not given it to you in a year, they are given it to you over the vesting period by which these employees are retained in the company. So there are three benefits of having a ESOP plan. First is attraction, then retention, and the third one is motivation. इसके ऊपर MCQ जरूर आएगा. Now, what are things we have to consider when implementing ESOP? The very first one is legal and regulatory compliance. You have to understand what all compliance which you have to do as a company for having an ESOP plan and do all that compliance. Second is equity allocation. Understand how you are going to allocate equity between the employees of a company. Whether you will give similar equity to all the employees, or you are going to decide it based on the factors. Understand it and have a proper policy of it. Then third is vesting schedule. Have a vesting schedule formed in such a way which will motivate them and also retain them for a longer period. Fourth one is valuation. Understand the equity shares value of a company to decide the exercise price. And the fifth one is communication and education. Properly communicate, transparently communicate with the employees regarding their ESOP plan, that this is our factors which we consider at a time of equity allocation. This is the schedule and this is the exercise price. Properly communicate it with the employees. Now let's understand the best practices for founders. This is also important. The very first thing is start early. Whenever you are going to start a business, first thing you have to do is have a proper ESOP plan, because this plan will help you to attract a top talent in your company, which will help your company to grow, and transparently communicate about such ESOP plan to the employees, by which they should feel motivated and they should retain in the company. Communicate it with them that this is our factors which we consider for ESOP, then this is your schedule and this will be the exercise price. Regularly review your ESOP plan. As your company is growing, understand that whether there is any changes is required in your ESOP plan. Fourth, educate employees. Tell them that if you avail this ESOP plan, this will be the taxation, but this will be the benefits which you can have. And fifth is celebrate success with them. Whenever the company is growing and achieve some milestone, celebrate these milestones with them to recognize them that they were also part of this journey. This process has been successfully followed by these three companies, Flipkart, Google and Salesforce, where they started early of having ESOP plan, give ESOP to their key employees, and as the company grow, all these employees have created their wealth with the company through ESOP. This was all about ESOP planning. Now let's understand our fourth concept, that is co-founder and co-founder agreement. Now we already know what co-founder is, right? Now let's understand why having a co-founder is very important. The first benefit is shared vision and commitment. When there are two or more people who are working towards a similar vision, their vision aligns with a startup mission, then it brings mutual dedication which help overcome early obstacles and drive progress. The second one is diverse skill set. Definitely one individual will not be expert in different field, but yes, different field experts can come together for similar vision. Now this will bring expertise and different perspective which will boost innovation. Third one is support and collaboration. In tough phases, these co-founders act as each other's advisors. Fourth one is risk sharing. As they are sharing the responsibilities for the startup, they will also share the risk for the startup. Fifth one is network and resources. Here they will be using their personal network, personal contact, personal resources for the success of startup. And the sixth one is long-term stability. If there is a solid co-founder team, then it will ensure that stability and sustainability is maintained in the business throughout the years. And the seventh one is lock-in period. Here they will mention a lock-in clause which will help secure a co-founder during critical early years, because when you start a business, few early years are very much difficult, and in that years founder should not exit from the startup. That's why they mention lock-in clause for preventing premature exit that could disrupt growth. Now let's understand about co-founder agreement. A co-founder agreement is a crucial document which will outline the terms, responsibilities and expectation between founders of a startup. This co-founder agreement acts as a blueprint for a partnership, clarifying the roles and mitigating potential conflicts. Now let's understand a comprehensive list of areas covered in a co-founder agreement. The very first one is introduction. Here they will introduce each and every co-founder and also about the startup. The second is roles and responsibility. This co-founder has this role and has this responsibility. Also here you will mention their decision authority, that this co-founder has a right to take decisions regarding this field. All such things will be mentioned in roles and responsibility. Then you will mention about the percentage of equity stake owned by this co-founder. Also how much capital they need to be contribute for the startup. Then decision making. If they have to make some decision, how they will make it. What is the authority of making decision. Also here they will mention how much voting rights will be there with each and every co-founder. And if there is any dispute, how they will resolve it. Then intellectual property rights. If any co-founder has given their IPR to the company, then here they will mention about it. Also if there are any restriction have been imposed, then what all restriction have been imposed on such intellectual property rights will be mentioned here. Then confidentiality and non-disclosure, that the founders should not have to disclose the trade secrets of the company, and if they did, what will be the repercussions of that. If they want to mention about the non-compete clause or non-solicitation clause, they can mention that founders should not accept clients at the personal level. Also founders should not solicit their employees or their customers. Then term and termination, that for this term the agreement will be valid. If any founder terminate, then what will be the repercussions of it, it will be mentioned in term and termination. Then we will also mention about the succession planning, and also if any founder leaves in between, then how his shares will be reallocated. A proper method will be written and it will be mentioned in the agreement. Then governing law and jurisdiction, regarding these are the laws under which this agreement has been made, and if there is any miscellaneous provision which is not covered above, will be also, it can also be mentioned in co-founders agreement. Here the co-founder agreement governs through following laws. First is Indian Contract Act, and then the Arbitration and Conciliation Act for mentioning that for dispute resolution, and then if it's company, then Companies Act, if it's partnership, then Partnership Act, and if it's LLP, then LLP Act, that is Limited Liability Partnership Act. Now let's understand our last concept, that is registering intellectual property rights. So whenever a startup has done something innovative, now this innovation can be in product or it can be in process, and they want to legally protect this innovation, then they have to apply for a patent. Once they apply for a patent, they get the legal protection for the innovation, where they will have an exclusive right to manufacture, use or sell such innovation for 20 years from filing date. And this is very important, this right is given to them from filing date and not from grant date. For example, pharma company has patented their new drug formulation. Now this pharma company will exclusively have the rights to manufacture, use or sell such drug for 20 years. So here you can see, once you have applied for the patent, it is protecting your innovation. Now you can recoup all the R&D cost which you have incurred for such a new drug formulation. This will secure a competitive advantage. This will give you a competitive advantage in the market for 20 years. That's why a startup has to register their innovation. The second is copyright. Now this gives a protection for the original work of a creator. Now this original work can be a song, it can be a movie, it can be a book. In a copyright, you will get the protection for your original work till your lifetime plus 70 years after your death. Now this is given in module, but in India it is lifetime plus 60 years after your death. But in module they have given lifetime plus 70 years. So if they ask question around it, you have to answer it based upon what is given in module and not what is something which is right. Once they change it, then you can apply for the answer which is lifetime plus 60 years. But till the time they have not changed it, you have to give your answer based upon what is given in module. For example, J.K. Rowling has copyrighted their Harry Potter series. So here, with the help of copyright, they have safeguarded their creative work from unauthorized use, and now they are the one who can monetize this creative work. Then there is a trademark. If you have to register your logo, name and slogan which is distinguishing your company's goods or services from the others, then you can do it through trademark registration. Once you've done your trademark registration, you will build your brand identity. Also it will prevent others from using your brand identity, and it will protect your market presence. These are the few types of intellectual property rights. Now let's understand how to register for patent. So before making any application, you have to do these two things. The first thing is determine the eligibility of your patent. There are 3 criteria given in the act. First is your invention should be novel. That means it should be new. then it should involve an innovative step. This step can be through technological advancement, or it can be through any improvement in a process which was not there earlier. Now this technologically advancement or improvement should not be something which is very obvious for the skilled person in that field. If it is obvious, then it will be not be treated as innovative. Also, the third criteria is it should be practically applicable. It should be applicable in that particular industry. If these three criteria are satisfied, then only you have to go for next step. That is, conduct patent search. Verify that your patent is unique and such innovation has not been already patented by someone else to avoid conflicts. If these two things are done, then apply for a patent application. Draft a detailed description with diagrams, and if any expert help is needed, then take the expert help and draft an application. Submit this to Indian Patent Office either online or through person with required documents and fees. Now, Indian Patent Office will review your application. If it is acceptable to them, then they will publish in their patent journal. Now, publishing it in a patent journal doesn't mean they have registered your patent, registered your innovation. Then you have to make a request for them. There is a request for examination which you have to compulsorily do within 48 months of your application. If you didn't file a request for examination, then they will not review your application. उनको रिक्वेस्ट करना पड़ता है कि भैया जरा देखो मेरा एप्लीकेशन, प्लीज देखो प्लीज. ऐसा प्लीज बोलने के बाद वो तुम्हारा एप्लीकेशन इवेल्युएट करेंगे. दे विल इवेल्युएट योर एप्लीकेशन, एंड इफ देयर आर एनी ऑब्जेक्शंस, देन दे विल कन्वे दैट ऑब्जेक्शंस टू यू. इफ दे डोंट हैव एनी objections, then they will grant a patent to you, where you will have an exclusive right to use this innovation for 20 years. Then you have to pay periodic maintenance fees to keep patent active. And the last thing is enforce rights against infringement to protect your innovation in the market. This means if someone is unauthorizingly using your innovation, then you now have a right to take a legal action on that person. So this is the end of your chapter number 7. If you are loving this series, make sure you subscribe to our YouTube channel and like this video. Tab tak ke liye tata, bye bye. Now see you in the next lecture.